Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Let's get some thoughts on both the equity market and the bond market. We're joined for our drive to the close with Sylvia Jablonski, CEO and Chief Investment Officer over at Defiance ETFs. She joins us from New York City, also with us for the bond side.
We love this. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey joining us from New Jersey. All right, Ira, I want to kick it off with you. The decision, the rate market reaction. Walk us through the day, what happened with CPI, and then what we got from the Fed and what really stands out for you in terms of the fundamentally kind of backdrop on inflation and Fed think, and then how investors are perceiving it and traders are.
You're asking me for a whole dissertation here.
Sorry.
But
defend away. Defend away.
All day to prepare, Ira.
That's right.
So for CPI, obviously the better than expected CPI number, I think, gave a lot of people relief, particularly in the bond market. And you saw a big rally in all across the yield curve. So you had 2-year yields and 10-year yields both lower by about 15 basis points at one point. And we kind of hovered there until we got the summary of economic projections, because the statement didn't really change. I mean, there was basically one word of any significance that changed there. But the summary of economic projections, I think, surprised some people in the rate market, with only one cut now being the median dot this year, and 4 members who think that the Fed's not going to do anything this year, that they're going to remain on hold. So, a little bit more hawkish there, sold off a little bit. Then Jay Powell starts to talk half an hour later, and we wound up with him being a little bit more hawkish. In fact, we have a natural language processing model that parses all the words, and we looked at his opening remarks this morning for this afternoon. Seems like this morning, the last 2 hours, this has been absolutely crazy. But he was a little bit more hawkish than he was in May, and then the market sold off a little bit more. So now we've given back about half of the gains in the bond market that we made after the CPI report. And I think that, traders are still trying to figure out, is the Fed actually going to cut? And if so, when and how much? That really affects the 2-year note. The longer end, what we saw was basically the Fed pushing out their more rate cuts into 2026 now, because you have 2 less cuts this year than was in the dots, the same number of cuts next year, but then the terminal rate for 2026 is exactly the same. So basically, the for the long end of the curve, if people think that the dots are going to be realized, which they don't, right? No one actually thinks that what the Fed says is actually going to happen. They're going to
my
yeah, exactly. They had to at least take some profits before the end of the day.
You passed the oral examination for your dissertation. You are now Dr. Jersey. All right, let's get to Sylvia Jablonski and get her view on this. Break it down for us in terms of what we got from Jay Powell and company, and what that means in terms of the investing environment, Sylvia.
Hi, Carol. Great to be here with you today. Yeah, tough to follow the lead on that dissertation there today. But, I think that in terms of what happened today, it's pretty much what the market expected, right? We didn't necessarily get a cut today. It's good news that CPI data is cooling off. It looks like inflation is trending downwards, and this is really what the market wants to hear. I actually think that we're in the sweet spot now where equities are going to kind of continue to rally, because we do have rate cuts coming. Maybe we don't get as many as we thought this year. Maybe it gets pushed off, but we're just talking a couple of months here. So rate cuts are coming eventually. And this is kind of, stocks really performing on this news. And so I think overall it's good for the markets. This feels a little bit like a soft landing. You have inflation coming down, jobs numbers are, maybe a little bit hotter than they should be, but certainly, stable. Wages are stable. Economic growth slowed, but more or less in line with expectations. Corporate earnings are good. I think we're in a good spot in the market, and today doesn't change a whole lot, but it's a great data point.
Quick question to both of you. First to you, Sylvia, just quickly. I don't think I was listening to all of it, taking lots of notes, but did I miss anything? Did I hear anything about a rate increase?
No talks of rate hikes.
Ira's also shaking his head. I can see him. He's shaking his head saying no.
Well, Iris, that's
you passed the test too for doing a good job listening today, Carol.
Tim and I are kind of glued. Like we run to makeup, we run to the bathroom, like we've got our earbuds in, like everything, because we want to hear all of it and the tone. But Iris, that's significant that we didn't hear anything. Sorry, Tim.
Went there.
The great reveal of what happens behind the scenes.
Just so you guys know, they actually play Bloomberg Radio in the bathrooms here at Bloomberg News. So in the whole building. So
it's amazing that people come out like, that was a great interview.
Yeah.
Ira, having said that, significant that we didn't hear anything about a rate increase. And again, they're data dependent, so it could change.
Yeah, the chances of it changing, I think, is pretty low because, Jay Powell has been very reluctant, even when directly asked at the May meeting whether or not a rate hike was possible. He basically said no. He said at this point, based on all of their forecasts and everything else, they're much more likely to remain on hold than they would be to cut rates. So it is a bit asymmetric, right?
I mean, to raise rates. More likely to be on hold than raise rates.
Yeah, correct. To be on hold than raise rates. So basically, they're going to be on hold if inflation increases significantly, and then cut rates if the economy starts to deteriorate further or if inflation keeps coming down. And it's that asymmetry that's keeping the yield curve inverted and will likely continue to keep the yield curve inverted until they actually start to cut interest rates. And I think that's, someone pointed out to me today, one of our customers was like, 2 years to today is when the 2s-10s curve first inverted. And so we're at basically the longest period of yield curve inversion ever, and that's likely to persist, I think, until close to the end of the year. The other thing that's come out of this in my quick discussions with customers after Jay Powell spoke is there's a lot of people who think that a September cut is very possible. I don't think that's true at all. Maybe if they cut twice, but why cut in September? You're only going to get 2 more months of data points basically between July and September. So why bother? Why not wait until after the election? They moved the meeting of November. It's now going to be on a Thursday.
Yeah.
So they avoid having a meeting on election day, and they can cut rates then. And 6 weeks in the grand scheme of things, from the longer term thinking that we're markets people, right? We think about what the market's doing every second. The Fed is thinking more longer term. So 6 weeks in the grand scheme doesn't really matter. So I think that they would hold off until then. They could still cut twice this year. That's completely possible if the economy's falling out of bed. But we're unlikely to see that prior to election day, at least in my view.
Okay, Sylvia, I want to go to you and just get, you have this thesis where things look pretty good. We're in the sweet spot for equities right now. I'm wondering what derails that thesis. Like, what data could you see over the next few months that says, wait a second, things are not going the way that we think they should be going?
Yeah, and look, that's certainly happened, right? We get these events out of left field that we don't expect, and they move markets. And so I think that those events remain the same. If inflation, for example, were to suddenly start increasing or just, doesn't budge for long periods of time, I think that, kind of challenges my narrative. The other thing is, of course, geopolitics. This is, over the last few years, it's the first time where we have 2 very active, global wars going on that are, ticking time bomb, could be ticking time bombs at any moment. And I think that that's something that we always have to think about. China and Taiwan, what happens during the election, tariffs, things like this. So I think it's any of these kind of, unexpected events that have to do with geopolitics and politics, I'll say. I don't think inflation is going to be the thing, to be honest. Yeah. I think it's something like that.
We are data dependent too. We kind of move from data point to Fed speak to Fed speak. Just got about 40 seconds. Really quickly, Sylvia, 20 seconds for you. Your next focal point, just quickly.
Yeah, I mean, I'm still looking to build out the AI trade and look for those opportunities. So starting to expand it to things that AI will benefit, like healthcare, like the materials, uranium, copper, things like that. So looking for some new investment ideas around that theme.
10 seconds for you, Ira. Next focal point.
Yeah, it's all about the data. So it's retail sales and then the PCE data at the end of the month.
All right. So appreciate dynamic duo. Both of you passed the oral examination. So really good stuff and great setup for us.
What time are the papers due? Tonight?
I don't know. Now you go celebrate, right? Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence, and Sylvia Jablonski. She's CEO and Chief Investment Officer at Defiance ETFs.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Fed officials, as you know, penciling in just one interest rate cut this year, forecast more cuts for 2025, reinforcing policymakers' calls to keep borrowing costs higher for longer to suppress inflation. Fed Chair Jay Powell at today's press conference after the decision.
We see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
High for longer. That is Jay Powell.
I've heard that before.
Yep. It's not a new narrative.
He's not. I would say he's not full of surprises.
No, steady.
Which is probably what a Fed chair should do. Yeah, right?
Yeah, exactly. So I'm curious about how it impacts the investing environment. So let's get to that. Alexandra Browne is with us. She's Senior Managing Director, Chief Development Officer at the Family Office Wealth Manager, Lido Advisors. They have some $19 billion in assets under management. She joins us here in our Bloomberg Interactive Broker studio. Ali, welcome. What, if anything, and I am curious about, we obsess, as you would expect, and as you just heard, about the Fed and what Jay Powell has to say, but it does move markets. So what about what we got in terms of the Fed decision, what he had to say about kind of color around the economy and the outlook, impacts kind of your world?
Oh, absolutely. It's everything that we do. But understanding and educating yourself is one piece.
Yeah.
Where were we 6 months ago? We projected 6, maybe 7 rate cuts.
Yeah.
We haven't had one, and yet the market's hitting new ultra highs. Right. So the question is, how do we, I think everyone's waiting for that first cut. When is that first cut going to be? I do think if we would have seen signs from the press conference of having a second cut this year, we might have seen stronger futures be producing now. But it absolutely plays a role. But I think where we are now, it's proceed with caution. And how do we proceed with caution? How do we build the portfolios to look like that? It's interesting because one would argue in the wealth management space, pre-inflation, it was a hard world to retire in, right? When you exit the workforce and you move from the accumulation phase of your life to the withdrawal phase of your life.
Because you couldn't get anything out of the fixed income side of things.
Well, yeah, it was either you're in or you're out.
Yeah.
Either you're making money or you're making nothing.
But at the same time, stocks were up double digits year on year. With the exception of just a couple of years because of that low rate environment.
Exactly. Yet we raised rates substantially in 2022. The stock market soared in 23. It's still soaring in 24. So how do we look at that?
I'm curious about your clients. They're high net worth individuals, family offices, family money, maybe passing on to generation. Where is it that they typically like to invest in your world? Because Tim and I spend a lot of time talking about increasingly family offices wanting to be in the private markets. But I'm curious about where a lot of your investors ultimately, invest, and they tend to park it then for a long time.
Sure, but it's also understanding there's so much similarities between the family office space and the retail space. Let's put it into perspective. You sell a business, and now you have $500 million, a lot of wealth, right? I have yet in my career to see a $500 million family have 60% in stocks, 40% in bonds, and rebalancing once a quarter. So where
are they?
Yeah, so what is their goal? Their goal is to build in control. How do I build in more control around outcomes like we're seeing today that we have zero control around? Whether it's building in alternatives within the portfolio, with real estate, right? It's amazing. You look at a real estate investor, they're typically very heavy in real estate and cash, right? Why? Because there's a lot more control in that aspect. So building in control, whether it be using alternatives, and there's ways to build in control in the liquid markets. But drill
down, where in alternatives do you find your folks wanting to put their money in this environment?
We like the alternatives. We work in all aspects. So whether it's we buy real estate, we lend on real estate, private equity, middle market lending has been the topic of every conversation lately, all the way up to hedge funds, right? Which is an interesting factor if you see the amount of money pouring into hedge funds now, because one is arguing, is that tactical, active, single stock management beneficial? Are you getting value there?
Right. What's a typical allocation to alternatives in a portfolio?
So it very much depends upon the client, what the client's seeking. I think the big thing that we look at on our end is the need for liquidity. What people don't realize is that you don't need 100% of your money liquid on a daily basis, especially when you look at building alternatives into tax-deferred accounts that have longer time frames. So it's all about the client, the need, the desire, where it's fitting from a tax perspective. I'll give you a quick example. A client that maybe has one of the long-aged pensions, right, that's completely covering their income needs, their portfolio can be a lot more aggressive and a lot less liquid than maybe someone who's needing to pull out of their portfolio on a consistent basis.
So they might have a higher concentration of alternatives because alternatives are less liquid.
Right. And they can play because they've already got something kind of as their safety net, if you will. Having said that, I am curious, among the wealth clients that you guys work with, what is it that they ask you about the most? Is it something like NVIDIA? Is it AI? Is it Fed policy? Is it the fixed income? Like, I'm just curious where they are like, wait a minute, is that an opportunity for me?
Listen, AI we can't ignore without question. It's just the way we're seeing it promote itself. I mean, look at this week, for example, with what happened with Apple, right?
So do you say get into Apple now?
I would say proceed with caution. It's all about, everything has a place within a portfolio. It's a matter of how much and where and understanding. So clients that come to me and say, I want private equity exposure because they heard about it at the golf course, right? It's an education.
Which covers a lot.
Which covers a lot, and what sector and how liquid.
Big bucket.
And so there's a big education around the alternative space and what goes into that bucket.
How do you give clients exposure to private equity?
Yes. First of all, we need to educate them, right? They hear the word. Yeah.
Right, but I mean, you can get exposure to private equity by buying the stock of a publicly traded firm that is in private equity, but you can also go to an alternative asset manager, which a lot of wealth managers work with, and then buy into their funds as well. What do you guys do?
We do a combination of both. I would say more the latter. The private equity space that we do is in the private space. They're very opportunistic though. And
so it's not like you're buying KKR, you're buying, no. Okay.
No, and it's opportunistic. We have a deal, the deal closes quickly, right? So it's a client that we're building, hey, listen, we're going to build an allocation for private equity, and this deal that may come around this week may work, and it may not, and we'll reevaluate when the next one comes around.
What do you say in terms of how you think it's smart for your clients to get exposure to AI? And these are folks that will park money for a while. So what is it?
I don't think we can ignore it. It's going to touch, AI is not just tech.
But how do you play it then? Or how do you suggest?
There's ways to get exposure to AI with controlled outcomes, right? Whether it's using a combination of options, saying, listen, I want to participate in this space.
Yeah.
I want to grow in this space, but I don't know if I necessarily want to take very directive risks. So I'd like to get exposure, but how do I build in protection? We do a lot of options in-house.
Like against a specific equity name,
I would
perhaps?
say against, but very different.
Or with,
right? So options, I think, get a huge negative connotation in the market as the media.
And I didn't mean it like that, because there's two sides.
Yeah. No, absolutely. So is there a way that we can get exposure to a certain number of AI stocks, right, where we can participate if things go up, but have some protection if we're wrong, to avoid that timing component?
Speaking of AI, we are getting Broadcom earnings right now. Second quarter adjusted earnings per share beat estimates. We're seeing stock move higher in the after hours right now.
Up about 8%.
Wow, yeah, stock moving higher in the after hours. Sees fiscal year revenue approximately $51 billion, beating estimates of $50.6 billion.
Yeah, we'll be looking for some more color when it comes to certainly AI and chip.
20 seconds, do you use AI at your firm yet?
Yes, in different types of ways.
But were you using AI for years?
We are doing more and more. It's educating ourselves and how to incorporate it effectively. Being in the finance world, we're so regulated. So as AI gets more regulated, I'm interested to see how it bleeds into finance.
Thank you. Really appreciate it. Ali Browne, she's Senior Managing Director and Chief Development Officer over at Lido Advisors, joining us here in our Bloomberg Interactive Broker studio. More on Broadcom. That's coming your way in a moment.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Broadcom just out with earnings, Carol. Shares hitting an all-time high ahead of results,
Stock
also
note.
rallying big time after market.
Up 9% right now.
Look at that.
Yeah.
This after an upbeat fiscal year revenue forecast. Let's get right on over to Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst, joining us from our San Francisco bureau. Kunjan, I mean, a lot of the chatter ahead of these results said that, yes, the numbers would exceed expectations. Did they exceed even your expectations?
They did, and in fact, it seems like we don't have the segment details yet. They will be given in the call, but seems like they expected on the two fronts which were the most important. One is on the AI side. It looks like the AI revenues beat what we thought it should be in the quarter, and the biggest beat seems to have come from the infrastructure solutions, which could be driven by better than expected VMware numbers, and maybe the non-VMware business, which was supposed to be weaker quarter over quarter, was not as weak as we expected.
Remind Kunjan, I always think about this when we speak with you or we talk with our Ian King, that not every chip company is the same. Remind everybody what Broadcom is all about, right? Because they're a chip supplier for Apple and some other big tech companies, but what type of chips they are specifically?
Well, they are almost like a conglomerate when it comes to chips. Like, look, for about 40 to 45% of their business is actually software. So you can't even call it a chip company, but they have a huge business with about 20%, 25% with Apple, which goes in the smartphone business. Now they have a growing business in networking, which is regular enterprise networking, all the connectivity chips in the data centers, but a big pie of that, which is supposed to be $10 billion this year, is the new AI revenues, which we will be looking forward to hearing. And then they have an industrial business, they have their regular storage business, they have an industrial business. So a lot of combination of a lot of business, but the key three biggest, largest are the wireless to Apple, the networking, and now the VMware with the software.
How safe is that Apple's part of the business, given that increasingly Apple's looking to do a lot of its own chip development in-house? And we saw what happened with Qualcomm too.
Yeah, out of all the chip suppliers to Apple, I think this, according to us, is the strongest relationship. So I would fear other companies losing out before I would start worrying about Broadcom, in short, getting out of Apple.
Okay.
You know, it's interesting too. I mean, when you look at like different chip names, I mean, what is this a barometer for more broadly in the semiconductor industry, Kunjan?
Typically, because of the way they run their business, which is a 52-week long lead time, they seem to have less volatility, less sort of channel inventory buildup, and less sort of this whip kind of a demand. So it is generally a good indicator of long-term, an year out or more out, how the demand is looking. More and more, it has become an indicator of how the AI demand from the ASIC side is looking. So what I mean is how much are Google, Microsoft, Facebook, etc., all of these companies spending or going to spend in their own custom silicon programs, because Broadcom is one of the biggest supplier to the largest cloud providers in their ASIC businesses.
We're seeing second quarter revenue from AI products come in at $3.1 billion. How does that sort of gel, Kunjan, with how you're thinking about that part of the business?
Yeah, we did expect this to be in sort of in the 2.7 to 2.9-ish range, so
Okay.
Definitely came above. One thing I would be very focused on is their full year guide only came above 500 million than what was on the street. It would have been, investors were hoping for a higher upside to their 10 billion AI revenue target for the full fiscal year, as well as some higher upside to the 12 billion VMware target. So at this point, I guess because the upside is only 500 million, I'm likely that both of these areas did not sort of hit it out of the park, but still an upside to the numbers we were expecting.
Hey, top of mind as we get ready for the analyst call with Broadcom, what are you going to be listening for? What would be your top question to the executives there?
Yeah, again, the three key areas would be more upside or engagements on the AI business, especially with Google's TPU 5 and 6 ramps expected in the future. More upside or clarity on the VMware integration and how the rest of the year looks like. We want to hear better or above that 12 billion number if possible. And just third, on the cyclical areas, the sort of non-sexy but still a decent percentage of their business, which is broadband, regular enterprise spending, server, industrial, if Q2 will mark the bottom or not, or if we expect continuous weakness into 3Q.
I hesitate even to go here because it's not about fundamentals, but the company also announced a 10-for-1 forward stock split this coming just the same week that we saw NVIDIA stock do a 10-for-1 split. Do you
and
care?
a quarterly
do you
stock
care
dividend
at all?
of $5.25 a share.
That part's important. But
Yeah.
do you care at all about the stock split?
I mean, you would think, and today's day you would not, but we saw the reaction NVIDIA got, right? And Broadcom is one of the other AI names here and doing the same thing. So definitely, I think some of the reaction could be driven by that 10-to-1 stock split.
Kunjan.
Yeah.
Thank you so much.
stuff.
Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst. We're going to let you get back to covering Broadcom because I know you got some reports to write.
Just a quick rehash. Shares of Broadcom up about 9.5% in the aftermarket. This as the company, its latest results and annual forecast topped estimates, out there on the street, lifted by robust demand for artificial intelligence products. So definitely some upbeat. So we'll look for some more commentary when the call begins.
Yeah, shares higher right now. Look at that, Carol.
Yeah.
Change from the open up 9% today. Change from previous regular session close 12%.
And that's building on a more than 30% gain, 30% gain here in 2024.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.